Welcome to the monthly video update. This is being prepared Sunday, April 3rd, where I will cover the month of March 2020 and the action that occurred. And then we'll look ahead to April 2022 to see how things look to unfold in the upcoming month. For the month itself, we were up 3.58%. We did see above average volume overall. But what is kind of interesting is we saw some days where there was consecutive declines in volume. The typical adage is that any kind of a move, whether it's up or down, if it's on a decrease in volume, you're very suspicious of that move. Well, that kind of went a little bit backwards, at least to this point. Volume tended to taper off as prices were going higher. And you would expect on the down days that we had, volume would really spike, but it really didn't do that all that much. So what I'm personally thinking right now is there's a lot of indecisiveness. How can the market be going up with all these negative things that are happening in the world? We have inflation, we have interest rates, we have Russia, Ukraine, we have oil issues, we have an inverted yield curve. We have all these different things going on. How can we even think that the market would go higher from here? And that's just about the time when the market does what you think it won't do. It's a real equalizer in that sense. So we'll go through, look at some of the charts, see what kind of a conclusion we can reach, and then what it looks like moving forward. Our trend is positive still, but it could be weakening. And I'll have an ADX chart to bring up to show you that. So what are some of the comments that we can make in the past month? The month started out by declining, just like a lion, and there was a real increase in fear. And we hit a point where pretty much everybody on the planet thought we were going to crash from here. So what did the market do? It bounced up. It has a real way of doing that. So in about the middle of the month, a bottom was found and prices really started to advance. And this wasn't just your little bounce. This was a strong advance. And we saw multi-percentage gains day after day after day in all of the indexes. And it was pretty broad-based, but most people didn't really believe that, okay, it's just a dead cat bounce. And they just thought we're just wearing off our oversold condition before we're getting set to go lower. Well, we kept going and going and going, and things kept looking more and more positive. And then about at that time, there was a real decrease in fear. And about the time the market was starting to look more positive, we stalled out. And that's why it's really good to try to develop the skills instead of reacting to what happens in the market. Develop skills that let you proact. You see things before they happen. You know scenarios that you're working through. And if certain things happen, you go in that particular direction. And as much as possible, you try not to let emotion or intuition or somebody else's advice feed into it. You just say, okay, I'm just going to go with this. Because some of the best, I've been doing this about 30 years, and some of the best trades or positions that I've ever had, they didn't feel like the right thing to do at the time. In fact, it was going totally against my logic. But that's what often happens. That's why we use technical analysis. That's why I do daily, weekly, monthly charts. That's why I look at everything I possibly can, so that when it comes down to that time to make a decision, you're using as much information as you can to help you in one direction or the other. And you're not always going to be right even then. So then you have a backup plan that's already set in place before you even get into a position. And that's the program I teach. That's the analysis that I do. And that's what I'm hoping to help anyone who listens to these videos. I hope I can help you to also develop that skill. It's a very liberating thing to develop. But getting off my soapbox here, the last week we kind of stalled out. That's when everybody said, okay, the Dow got back above its 200-day moving average. Other indexes got above their 200-day moving average, and they became believers, and we just kind of treaded water for the last week. The technicals are still positive, but they could be weakening. Now that's looking on a monthly chart. That's the time frame. I don't have any weekly or daily charts that I can remember that I'm going to show you here. We've got a lot of geopolitical things going on. Russia, Ukraine, inflation, interest rates, the lockdowns again in China. What's that going to do to the supply chain? We have yield curves that are inverting, and some of them are even going in opposite directions of each other. And incidentally, I do have that I posted about a week ago in the month of March. There's a video about yield curves that you might find useful just to kind of pick through. And then I have some advice on that as well. And then oil, of course, we all feel that every time we go anywhere, and we're seeing oil prices really going up. Well, there's been some news recently saying that the current administration is going to go ahead and start putting out, I think it's 1 million barrels a day or something for the next 10 months. Well, that dips into our reserves. That's supposed to be for emergency use only. Is this really an emergency? And what happens if we get partway through depleting our reserves and then we need that in a military way? What's it going to cost to get that reserve back filled? When we filled them before, oil prices were a lot lower. What's it going to cost to refill it in the future? Then the other side is saying, no, we've got oil just sitting there. We need to, it might only bring a gallon of gas down about 2 or 3 cents, but hey, we can pat ourselves on the back and say, look at how we're helping people. So there's a debate going on, whether that's the right thing to do. Do we look to build up our own oil production within the US? Do we still try to purchase oil from other countries? That's part of the whole debate going back and forth right now. So that's feeding into a lot of the uncertainty. How can the market be going up with all these terrible things that are going on? Okay, then the economic reports that came out over the month, they give pretty much overall support to rate hikes. We are in a rising interest rate environment now. And so the days of trying to get to 2%, I think those days are kind of gone now. Now we're trying to not get to 10%. And that's on how we measure it now. If we go back to how it was measured in 1990 or in 1980, we would be at anywhere from 12 to 15, 16, 17% interest if we calculated it now the way that we used to calculate it back then. So there's a lot of uncertainty. Consumer sentiment is not doing very well. People are just not happy. And then there's this debate going on between the Fed and the economy. Well, we're seeing a rising interest rate environment, so we need to raise interest rates. Okay, yeah. Well, we have to try to do that at the same time without messing up the economy. It's called a soft landing. They try to Goldilocks it and have it just right. It's never happened before. It's an elusive goal that they always tried to do, but the US economy is so complicated and there are so many variables. You can't allow for everything. You can't make it black and white like that. So that's part of the debate going back and forth. And those are parts of the forces that feed into the stock market. And depending on what day it is, sometimes good news makes the market go down. Sometimes bad news will make the market go up, and then vice versa, the way you would think it would usually work. Well, it doesn't always work that way. Now, our current market valuation, we are overvalued. And I have one chart that I'll use. There's also a website that I go to for my daily videos, but I'm going to show you a chart. Now, this will be updating because we're getting near the end of the earnings season and the report should be coming out that'll allow me to update some of the charts that I look at. So how's our trend doing? The trend is still positive, but it is weakening. So, and I'll have a chart to show you there. Our bias is positive because we had an up month. That's how I do it. If on the daily videos that I do, if we had an up day, the bias was positive. If we had a down day, it was negative. The momentum, though, was kind of more mixed because we take that over the last on a daily basis, we go the last 2, 3, 4, 5 days. Well, here we go the last 2, 3, 4, 5 months. And that's a little bit mixed because ever since the beginning of the year, we've gone through 3 months now. The stock market has really had to fight just to get wherever it's gotten so far. Okay, so let's go back and look over the month. What this is a 60-minute chart. Each one of these bars is 60 minutes. I usually look at a 10-minute bar chart, but it would be so small and so crazy that it would be really hard for me to display that here. So right over here, I have my cursor. This is the beginning of March right here. So we kind of started off, we went a little bit down, then we made some advances. That was pretty good. So March looked okay, but then we had a really rough patch going down into March 8th, March 9th. We tried to bounce up out of that. And then right about March 14th, that's when we hit the bottom. And you can see here, we were at some pretty good support for this. Yeah, there's times when we could have gone a little bit lower, but we didn't. We found some support right at this level. And then, baby, we shot to the moon for the next, well, up until about the last week of March. And this is one of the most powerful moves I've ever seen. To see an annual return within a week to a week and a half is kind of an amazing thing. And I don't have the charts to back this up, but there's a lot of different studies that if you take this push and you compare it with other times when we had a similar push up, and the results are very good looking forward. So if you're more bullish on the market, that might really help make your case that prices might go up from here. It doesn't mean that's going to happen. It just means when the situation like this is developed in the past, it's led to good things in the future. Then this last week, we kind of trailed off and we ended up giving back some of the gains that we saw from the week. And we pretty much treaded sideways for the entire week. So, and then over here, you can see the pivots that I have. These can act as resistance or support. They're, in my opinion, they're more prevalent on the 10-minute chart instead of the 60-minute chart, but these are still helpful to look at as well. For the month, the utilities sector, which has been doing really well, it performed the best. It was up 8.61% for the month. Real estate, which has been hitting some hard times, utilities were up 12.81%. I have to make sure that little circles are there. Real estate was up over 10%. Materials, energy, you can just see all of the sectors overall were up, with communication coming in last place. And it's having some weakness right now, and then staples and so forth. But this is pretty positive to see all green over here on the side for the entire month. And this is what the different indexes did. You had the NASDAQ 100 was up over 6%. Here's the S&P at just over 5.5%. Then the NASDAQ, the Dow, the NYSE, mid caps, and then small caps as well. So all of our indexes going from March 1st to April 1st. I'm a little off because I'm recording one day after the end of the month. This shows some pretty healthy gains that we've seen recently. As far as sentiment, now I measure sentiment on, I use a lot of different tools, but a real popular one is the VIX. And this is the fear gauge. When this is spiking up, that means that there is lots and lots of fear. When this is going down, that means that fear is decreasing. And actually greed is starting to take over. Well, over the last month, we actually were able to drop below 20. And that usually 20 and above is fearful. You've got this sweet spot from 20 to about 12. And then when you start getting down around 12 and below, now you're complacent or you're overly greedy at that point. Well, we've been up in this fear area for quite a while now. Well, that has really dropped off according to the S&P. As far as breadth, we're still positive based on price and volume on a monthly basis. We're above the moving average. We're kind of kissing it a little close here to slightly negative with volume itself. But based on price, we are still positive. Here's the advanced decline ratio. We are turning up with the red line on top, and this is also a little bit negative because we are below zero, but we are going higher. And this is kind of an extreme reading. It could go lower, and it's gone lower before, but we were down around this area about the time we saw a pretty nice bounce. And then new highs, new lows. We're seeing new highs looking pretty healthy. And then I just do a 10-month moving average where we went up to sideways pretty much overall. And then this is the accumulation buying versus distribution selling. When we're on top of this red line and it's going up, that means more people are buying than selling. Well, we are above that currently. This is our trend. And I use this very heavily on the daily charts, but here's just a monthly view where when this line is going up and it's above 20, that means our trend is getting stronger and stronger. It doesn't tell us the direction of the trend. It just tells us that the trend is stronger. Well, if the green line is on top, that means we're in an uptrend. And then down here, the red line, that is selling pressure. That when that's on top, that means that we are going down. Well, I also have a moving average plotted on here. And when we start to drop below the moving average, that means our trend is weakening. And we're seeing the green line going down and the red line pretty much going sideways. This could indicate a weakening trend overall. Just want to keep an eye on this. We also look at it on a weekly and daily basis as well. And then this is a thing called the mass index. We now have a signal here. Not really, not quite. The idea is that when we get up to 27, that's signal part 1. And then when we drop to 26.5 or below, that's signal part 2. Well, we didn't really get up to the 27 this time, so we won't really pay attention to that. This is a rune. When the green is on top, that means that buyers are in control. The red line is selling, and that is seeing a decrease, but we're also seeing a decrease in buying. And then you compare the two lines with each other, and that gives us the oscillator. When the oscillator is above 0, that's positive. When it's below 0, that's negative. Well, we've been flat overall with this indicator, but we are flat in a positive kind of way. Now, let's look at some longer term charts. Here are some pivot points. Right now, we are above the pivot, and that is positive. We have some resistance levels above and some support levels below. And as things play out, we may or may not hit some of these different areas. These are monster moves on a monthly chart. And looking at the S&P with a 10-period moving average, we are right at about the moving average. So that would suggest that things are still okay. The moving average is going up, and we saw a bit of an advance on the chart. Then we have a thing called BPI, Bullish Percent Index. These are the number of point and figure buy or sell signals that are generated inside the S&P 500. Well, we've got to kind of an extreme positive reading now. I also have a moving average on here, which shows if we're going up, that usually is more positive. If we're going down, that could be a sign of exhaustion or downright being negative. Then we have the CCI. After giving us an extreme positive reading, it's come back down and turned up slightly. So that's positive. And then we have the Chaikin Oscillator. It is flat to a little bit down. So that in that case, you could take it as negative, but we are still above 0. So you could take that as positive. So this chart would be more of a mixed signal. Chaikin money flow. It's still green, which is positive, but it's declining, which would be negative. Momentum oscillators. Again, the longer out we go, the least likely I am to put a lot of weight into oscillators. If you disagree with me, send me an email. Put a comment in the video. We can talk about it. A lot of that just has to do with the way these things are calculated. And so, especially on a weekly or a monthly chart, these can take so long to shift that it's like, my goodness. By the time these things actually give a signal, what you're looking to have happen may have been history already. But we are starting to see a lot of these oscillators rolling over, but we've had a really good run up for the last number of years. And so higher values are being used as part of the calculation. And so these oscillators can't help but roll over. And when you're using them in longer time frames, I don't put as much weight in them, but some of you may disagree with that. Then we have the Mcclellan Oscillator, which when it's above 0, that's positive and advancing without giving us an extreme positive reading right now. And this is based on that same indicator. This is a summation index where we are advancing based on price. We've actually turned down a little bit based on volume. And sometimes this can lead things. So I want to be aware of that. We're seeing some negative volume action. The PMO, this is the oscillator. What I prefer to look at are these studies down below, which are just showing that we're seeing an advance based on price, and we're kind of a little bit flat based on volume. Here's another version of the PMO study where we're looking at those that have a rising PMO inside the S&P, that they are advancing. Those that are giving buy signals decreased slightly, and those that are above 0, it's kind of a little bit higher to flat right now. Then the percent B. These are Bollinger Bands that we have here. And when we get up to the upper side, a lot of times that will signal an overbought condition. When we get down to the lower band, that can signal an oversold condition. Well, right now, we're a little bit positive. We're above this dashed line here, but we went sideways for the overall month. And then this is the valuation chart that I'm talking about, where this is the S&P on a monthly basis. And if you look back in history, the PE ratio, the price to earnings ratio, which is just one tool in a whole toolbox of things that you could use. But this is one indication that the market is overvalued. Now, one drawback to this is that the values that are on this chart are based on things that have already happened. These are on past earnings, but they're on legally filed earnings that the company says these are the truth. Well, the stock market likes that, but it likes to look forward. So we come up with this thing called forward PE. That's not reflected on this chart. So that's one of the drawbacks here. But just to show you, when I talk about the S&P is overvalued, the average PE ratio since the 1870s is about 16.7. All right. Well, when we get up to 20, that's when stocks are considered to be expensive. Some people that use fundamental analysis, they will implement this method. When a stock gets to a PE ratio of 20, you sell it. It doesn't matter what's happening on the chart. You just now have decided that this stock is expensive, and so you want to sell it. If we get down to a PE ratio of 10, that is for a stock that is considered cheap. Doesn't matter what the price is. You're just looking at all the internals of that particular stock. You like it. You've concluded that the PE ratio is 10, so that looks cheap or inexpensive. The idea behind this approach is you buy stocks when they have a low PE of around 10, and 15 is kind of the midpoint. But then when they get up to 20, then you get rid of those stocks because they're too expensive. And a lot of people, Warren Buffett, a lot of the big time investors, they don't use this exclusively, but this is one of the methods that they will implement. Okay, so let's look at this. Here we have the S&P over here on the right. That's where we're at, 45, 45, 86, as of the time this video is being recorded. Well, just to get back to an expensive level, we would have to come down about 600 points from where we're at right now, down to 39.56. Just to get back to a neutral area, we would need to get down to 29.67. Ouch. And how about this? Just to get back to the point where we're considered cheap, we would need to get down to 1978.40. That is a massive decline. But you can see we've been in this situation for quite some time. So we can be overvalued for a long time. We usually don't stay undervalued for very long. But for the market to be above this, I mean, this is going back 2014, 2015. I mean, we're talking a long time. So if you look at this and go, I'm freaking out, I wouldn't sell everything. Well, we've been in this state for quite a while now. So the idea is to just realize, okay, based on this chart, we are overvalued. What are we going to do about it if things really start to turn? What stocks am I looking at getting rid of? What's going to be my criteria? Just developing a plan so that when things do start to turn and the components of your plan start to trigger, now you, instead of acting out of an emotional state, you'll be able to act out of a logical state, because you're making up this plan on a weekend or in the evening when you're not under pressure, when you're not seeing the value of your portfolio going all back and forth. The idea is to come up with these plans in a non-stressful environment so that then when you're under the gun, just carry out the plan. And believe it or not, that ends up being the hard part. People are great at coming up with a plan. They just need to stick to the plan. And then they make these last minute adjustments and they have these hunches that are just right enough to justify being able to use that method because you lucked out. Well, that's gambling at that point. And what we're trying to do here is apply solid logic to the market and take the gambling part out of it, because there's probability attached to everything in life. I'm sitting here right now recording this video. I could have an airplane hit me. Somebody could drive by and shoot me with a gun. Now, the probability of that is pretty low, but it's still in the probabilities of things. Even when we're looking at the market, we might have a high probability that we're going in the right direction, but anything can happen. Okay. So looking at another thing called the short-term oscillator developed by Carl Swinland. This is based on price, this is based on volume, and it declined over the past month. Then looking at the RSI, this is probably an indicator if you do use technical analysis. This is usually one of the first oscillators that they ever teach. We're above 50 and we did advance slightly. And then we have another one called the force index. It's still positive, but declining right now. And then another one called the Stoke RSI. It takes the stochastics and the RSI and kind of builds this dream indicator that, I don't know, a lot of people use this. Well, it's giving us an extreme negative reading after we saw some recent declines. It doesn't take very much for this indicator to move. So we could have 1 or 2 decent months and we could be shot all the way back to the top here. Another one that's also a little bit touchy is called the Williams percent R. It gave us an extreme positive reading for a long time, fell back down below that, and actually bounced a little bit to sideways this previous month. So that would be positive. Different trading systems. This is called the Elder Impulse system. When the bars are green, that's positive. When they're blue, that's neutral. When they're red, that's negative. Right now, for the last few months, we have been neutral with the Elder Impulse system. Here's another one called the Stop and Reverse, where when the dots are on top, that's negative. When the dots are below, that's positive. Right now, we still have the dots on top, which is negative. Different charts. We have a Kegi chart here. And when it's black, that's more positive. Then we have a Renko chart. When the boxes are open, that is positive. 3-line break. When the box is filled in, that is negative. And equivolume. When the candles are green, that's positive. When they're red, that's negative. So this is more of a visual type of chart. And then I'm going to have to mess with this. This is a point and figure chart. I'm going to have to bring it up here and then see if I can get it to the point where it makes some sense. This does not use time in its calculations. It just uses price movement. And it's such a big chart, it was really hard for me to get this on here. But as of right now, you can see we have a low pole reversal that was generated on the 1st of March. That's this signal right here. And that is considered positive. If it's green, it's positive. Well, now we need to see some more green X's be drawn in here, and that would make things even a little more positive. But this makes this chart very unbearable to try to read sometimes. Okay, now is it going to let me go to the next slide here? I've been able to do that before. Okay. Yeah, okay. Gotta love this live stuff. And of course, I can't believe this. Actually, I can. Actually, I can believe this. I'm sorry about that, folks. if you don't watch my videos very often, I usually have a different computer. I have different software. Well, I'm at a place right now where the power cord on that computer is not available. And I'm in a place where I really can't order it. I'm in Eastern Europe right now. And it's not like I can just, send out an order to Amazon to get a new cable for my laptop. So I have to go to my old laptop, and I don't have access to a lot of the software and editing tools that I usually have. And that's why I have to record this using Zoom. I have to record this using earbuds instead of a nice microphone. I know, wham, wham, wham. But that's why you get some kind of crazy things happening in the videos, because I also have editing software on my other computer where I could take out all this junk. Well, I can't really do that. This is more of a live recording, and I just have to go forward and let things happen as they may. All right, let's look at the broad market here. So here's the Dow, where we are right at about the moving average right now. Nice little run up. I have a 12-period moving average on this currently, and we're right at about that tipping point. Mid caps also right. It closed just a little bit below the moving average for March. Small caps a little bit below the moving average, and the moving average is going sideways. NASDAQ saw a really nice bounce, but still continues to be underneath the moving average. Then the NASDAQ 100 also a little bit below the moving average. And most of these will either be a 10 or 12 period moving average, because I used to use 10, and then I thought, well, wait a minute, there's 12 months in a year. Why not use that? And so I think I've gone through and made the changes, but I probably have missed a few along the way. The NYSE, we're a little bit above. Now that would be more positive, because that's a pretty broad base index. And then the Wilshire, which is also broad based, and we are right at the 12-period moving average. Then we have it's called the all shares. This is a monthly chart just looking at not only US stocks, but stocks outside of the US. And we're right a little bit, we closed a little bit below the moving average currently. Looking at some other indications here, this is the CRB index, and this is what I really use heavily for inflation. Well, we've just been shooting up out of this something fierce, even though we were down a little bit for the month. This is in a pretty strong uptrend, and that is feeding through to all the things that we have to pay more for every time we go to the supermarket. Gold looked like it was breaking out, only to come back down. Oil shot all the way up to 130, but then ended up, well, this is after Friday, April 1st, we closed just a little bit below 100. Silver also looked like it could be breaking out, but then came right back down. The US dollar has been holding up fairly well. Here's a monthly chart where it looked like things were not looking very good. Well, we've been in a pretty solid advance for most of 2021 into 2022. As far as bonds, here's a bond ETF, BND. This is if you buy bonds based on price. You want to buy low and sell high. Well, as bonds go down, interest rates go up. And this has been in a pretty hefty downtrend for pretty much all of 2022. And then here are the yields. These are the ones that are going up. And here we have the 30, the 10, the 5, the 2, and the 3 month. And you can see they're all starting to bunch up together. This is part of the inverted yield curve mess that people are debating back and forth right now. And then these are international rates, where we have the US at the top, and then we have the UK. The blue here is Germany, and the red line is Japan. And now this is something, and please, I've had to do multiple takes of this video. Please check out my yield curve video if you feel that will help you. But what I have here is, this is the S&P on top right here. And these are the different yield curves that we have available to us. Here's the 10 to the 2. A lot of people say that's the right yield curve to use. Well, and I'm going to try to make this bigger here, and hopefully we'll see what happens. We're just a little bit inverted right now. And a lot of people are saying recession, recession. Well, if you look at when we went inverted and then what happened right after that, it's not as pronounced on a monthly chart, but a lot of times after we get done being inverted, we can quite often see a pretty significant rise in the market. And it doesn't mean that the recession's starting today. It could be 6 months from now, 18 months, 24 months. It can come well into the future, and to the point where it's like, this is a recession? Did we have an inverted yield curve a couple years ago? Yeah, I guess we did. But see, people are getting all freaked out about this, but nothing is really going to happen until far into the future. And we don't even know what is going to cause all of that. So, but here, I just charted all of these together. Here's the 10 minus the 3 month. Look at that one's actually going up. Some people say that's the one to use. Well, we have the 10 to the 2 going down and the 10 to the 3 month going up. Nice and confusing. Here is the spread between the 30-year and the 5-year, gone inverted. Here's the spread between the 10-year and the 5-year, gone inverted. Here's the spread between the 10-year and the Fed funds rate, which some people that I really respect, they say use that one. It's going up. Okay, so take your pick. I mean, that's why I plot all of these things on here, because you have people that are very dogmatic about this and saying, this is what's going to happen. Well, yeah, but we also have other evidence that can suggest that it won't happen. So we need to make our own decisions on this. Okay, so what is our outlook for April? The long-term trend is positive, but could be weakening, as I was showing you. The rally that we saw in the middle of March, was that just a relief rally or a dead cat bounce, or is it an actual reversal? Right now, it looks like it has legs. And because a lot of people have finally got to the point where they accepted it, it might slow down for a little while. And then, of course, we have all these geopolitical developments, Russia, Ukraine, China, the different yield curves, oil, and I've talked ad nauseum about all those things. So what I like to do, no matter if I'm doing a daily, weekly, or monthly update on things, I always like to have an up scenario, a down scenario, and a sideways scenario, because those are the only three things that can happen going forward. What are the likelihood, or what are the scenario can we come up with for the market to go down? Well, in the short term, on our daily charts, we are overbought and we're at some resistance levels. So are the recent declines that we saw last week, is that a reversal? Are we going to get ready to go down further from here? That's a likely scenario. Or are we just going to wear off this short-term overbought condition that we hit when we were going up? And then once that's done, prices are going to shoot higher. I don't know. Nobody knows the answer to that right now, but we need to be planning for that, and at least have this in our thought process. Okay, another scenario to the downside. We're in a rising interest rate environment. Is that going to freak out stocks? Sometimes it does. Sometimes interest rates and stocks go up and down together. Sometimes they like to go in opposite directions. And then the yield curve concerns that I briefly talked about. There's been a lot of disbelief that the bounce that we saw in the middle of March, no, it can't go any higher. It can't go any higher. And then it did. And then about the time everybody said, well, I guess there's something to this, lo and behold, we stalled out and actually declined. And then right now, as I record this, sentiment is right in the middle. Is sentiment going to turn more negative? That's what we would need to see, at least a decline. Now, it's when we get to extremes. You don't want to always be a contrarian. You just get to be a contrarian when everybody is saying bad, bad, bad. Now you start looking for the good. And then when everybody says good, 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 then you start looking for the bad. That's a contrarian, but you can ride that wave, either positive or negative. Okay. Now let's look at the other scenario. What could happen to make prices go up? Well, we saw some strength after building a pretty solid base. The oscillators that we look at on the daily charts, they're positive, but they could be weakening because we saw some late month weakness. The moving averages that we're going above and dropping down to, they could be providing support as well as resistance. And then this disbelief versus belief thing going back and forth. Then there's also a chance that we could get into a sideways type of an environment. If our ADX drops down below 20 and we see a real slowdown in price movement and we get more to a trendless environment, there are periods of time when the market does not trend. The idea that it's always trending, read the book Random Walk Down Wall Street. Okay. Then when you finish reading that book, read another book called A Non-Random Walk Down Wall Street. You can make a case for either side. The conclusion that I've come to is there are times when the market trends and there are other times when it doesn't trend. And we use tools to try to tell us which is which. And then we can build our strategies around what we see happening at that time. Okay, now in addition to this video, this is the monthly markets video. That's the one that I'm doing right now. I do what's called a daily video. This is kind of the backbone of everything I do. But it gets kind of long sometimes. It can be 40, 45, 50 minutes or so. And so what I do is more of about a 10-minute overview of things. And you're welcome to watch that. I'm currently putting them on YouTube that anybody can watch. That it's not going to last forever that way. But for right now, that's the way things are going. But sometimes you might want to watch just the snapshot video. If you see something really interesting, or if you're getting to the point of making a decision, then maybe you go in and look at the full length video. I also like to put out weekly videos, and then here's the monthly video. And then after I record this, I'm hoping to record another one about the economy, different sectors that make up the S&P, and then I'll look at the international markets as well. So thank you very much for putting up with my technical difficulties and so forth. Have a really great month. I really hope I hear from you between now and next month, but I hope the trend is always in your favor.